Well, we are seeing a little softness to start the Friday trading session. We already talked today about how the record highs we've seen in the U.S. have been fueled by a handful of growth stocks. Our next guest is still bullish on the stock market and growth names, but tends to lean into companies that he sees as being defensive growth investments. Jon Hirtle is executive chairman of Hirtle Callaghan, and he joins us for a conversation. Jon, nice to see you. Thanks for the time.
Good morning, John. How are you?
I'm doing well. We're getting a lot of questions about the fact that you've got a few stocks, as I said, that have had this huge move this year, so much that they've created headlines around record highs for the U.S. stock market. The Canadian stock market obviously had a record high earlier this year, but there's been a trend recently where investors have been putting on the shelf a number of sectors and just sticking with the big winners. And then that is exciting and also I suppose terrifying to some who start hearing people compare, the current environment to Cisco during the tech boom and all that kind of stuff. Where do you sit on all of this?
Well, the earnings keep coming through. So Cisco during the tech boom was a different story. All the dot-coms didn't have earnings. They were trading on clicks, eyeballs. And so these technology stocks today are actually producing earnings. So I think it's a very different story in that regard. In some regards, for example, one of the clear things that all of us experience is recency bias. And there's a momentum trade here with these tech stocks that keeps going. And that is like the tech bubble in the sense that they're going up because they're going up and the money just flows into them. So, there are reasons to be thinking that at some point it's going to cool down. One of the things that's interesting to me is that Nvidia, which is sort of the poster child for the market, is in fact a product company. And the rest of the microchip world feels like a bunch of schmoes right now because Nvidia is the rage. And I don't think they're sitting on their hands. So I do think competition is going to emerge for Nvidia. It's a great company. It's got a great story. It's very much related to this AI world, which is like an industrial revolution kind of a change. But we tend to overestimate the impact of these kinds of changes short term, although we may underestimate them long term. So this has come a long way fast, and I do think it's prudent to start to think about moderating our enthusiasm.
I always think about, in sports where you've got this obvious star player, and then when you get to the big game, sometimes the game plan is all the other stars surround that star player to try to keep them at bay. To your point, maybe that's the story playing out in the chip universe, and we'll see if anybody ultimately catches up to Nvidia. But speaking of targets or targets on one's back, you have sort of put a target around a number of companies that you think can grow, but maybe don't have sort of the same dynamics at play as say in Nvidia. So when you talk about something like defensive growth, just remind us what goes into that thinking.
Well, it's the idea that there are companies that have moats, that have tremendous franchises and are cheaper. Even though they're not cheap, they're cheaper than tech stocks. So we still own tech stocks, but on the margin, we're switching to companies like the financial services companies, Visa and MasterCard, FICO, and then Waste Management, something that we know is not going away. It's a well-run business. It's got a moat around it. Other people have a hard time competing. It's got a great balance sheet. It's got earnings. So still looking at growth companies, but on the margin, switching towards things that are a little bit more defensive. And by the way, most investors have some exposure to the index. So there is a lot of tech stocks in our U.S. index. That's one of the reasons, for example, that the United States has outperformed the rest of the world is because we have more tech stocks. So this is a tech story. And if that tech story starts to dampen, then the whole situation will change. In other words, Europe may look more attractive relative to the United States. So it's a real, when you're in a position like this where you're in a transition, it's hard to make a call. So what do? You don't try to predict it. You try to prepare for lots of alternatives. And staying into lots of compelling ideas, we like to say we find the most compelling ideas we can and then believe each one a little bit. That protects you against an uncertain future.
So let me walk through some example stocks just to see how you put this into practice. Some you've talked with us about in the past, but there are companies like Visa and MasterCard, which, every time I check, they just keep chugging along. You might even call them technology companies. Some people maybe don't think of them that way. Credit rating players like Moody's. We've been talking a lot about what's going on in the waste management business because there's been deal activity there as well. Waste management is a name that might fit the bill. So companies that are growing, but they're growing in a way that just offers sort of the characteristics of something you can buy into over the long term?
Right, and just a little bit less frothy price-wise. You have to imagine that your goal as a serious investor, and we're chief investment officers, so we're not speculators and we're certainly not gamblers. So we're managing serious money for people with serious missions. So what you want to do, the goal is success. You want to succeed with certainty. That doesn't mean you win this quarter or you win this week or you are getting the best trade. That's not the point. The point is to recognize, we take a step back. All serious investing is about acquiring future cash flows at the most attractive rate. That's it. All serious investing. So where are those cash flows and how are they priced? So today, for example, the U.S. market's priced at 21 times future earnings. Europe is priced at 14 times future earnings. So I can buy European companies for 14 times their future cash flows. U.S., 21 times. There's always generally a premium for the United States and North America because it's a better place to do business. But the premium is substantially higher than it has been. So on the margin, it's the same story with waste management and Visa. Great future cash flows. I can buy them cheaper today. So that's really what we're saying is that as you manage this through time and you manage risk, this is all about what risks am I taking? And by the way, you don't get any return without taking risk. So it's what risks are most intelligent today and how do I prepare for an uncertain future?
And before I let you go, I just want to give a nod to the bond market. Here every day, already today, we've been talking about whether the Bank of Canada is going to cut interest rates again. Obviously, it's a big conversation in the United States, whether the Fed at some point this year is going to pivot to rate cuts. But the direction of interest rates is something to consider for anyone who's investing in the fixed income world. We had a board we can maybe show again to our audience. Your investment advice is to be adding duration when you see yields in the U.S. pushing to give or take the 4.5% range. Can you walk us through your thinking on bond market investing right now?
Right. We do think there's a trend lower in interest rates. So we believe that the core inflation rate is already around 2, maybe more than that, a little more than that. And so we think trends are lower in interest rates. So if we find that 10-year treasuries in the United States go to 4.5 or more, we tend to add maturity so that if we run into a very weak spot in the economy, which there's still a possibility, those bonds will appreciate in value as interest rates drop, and that will be ballast to the portfolio. It is key that you have the notion of bonds and fixed income is to provide ballast, to provide an anchor to the portfolio when volatility picks up. It's been a long time with the stock market going up. And so the idea that the cycle is over and the stocks are going to go up forever, it seems a little nonsensical, especially when you look at the geopolitical situation. You got a political situation in D.C. that has never been this dysfunctional and is getting worse. Then you've got Ukraine and Israel and China and so forth. So the idea that we are just, as investors, sanguine, and that we don't need bonds and we don't need cash. And by the way, cash can be a serious asset. We've got the T-bills paying over 5.25% today. So I think bonds and cash are important elements of a diversified program that are going to protect us if we get into a normal cycle where the stock market goes down.